Do I have a permanent establishment in Mexico? A permanent establishment, or PE, arises when a foreign company conducts business activities that generate economic value and are subject to local taxation. A PE is not limited to an office, factory, or warehouse. It can also be triggered by an agent with authority to negotiate contracts on behalf of the foreign enterprise. In essence, a permanent establishment determines when a foreign company must pay taxes on its local activities. With the adoption of BEPS, the MLI, ongoing changes in global tax regulations, and the SAT's increasingly aggressive audits, the threshold for creating a PE in Mexico has changed drastically, representing a significant risk for multinational companies. Before 2020, many multinationals used loopholes to avoid being classified as PE in Mexico. Common strategies included fragmenting activities among multiple local entities to prevent any one of them from constituting a permanent establishment, using agents without formal authority, claiming their functions were merely auxiliary and therefore did not create a PE. The 2020 BEPS update made the permanent establishment definition far stricter, including the anti-fragmentation rule, which prevents splitting activities across entities to avoid a PE, an expanded definition of dependent agent, covering those who habitually participate in contract negotiations, closing the door on the auxiliary functions argument. In 2023, the MLI entered into force in Mexico, modifying existing treaties to incorporate the anti-fragmentation rule and the broadened dependent agent definition. Additionally, the Mexican income tax law has since 2020 included rules for digital platforms and personalized algorithms, which may trigger a PE when interacting with Mexican customers. Updated regulatory criteria to remain aligned with international changes, and provisions stating that failing to pay income tax under a PE framework constitutes an abusive tax practice. The SAT has ramped up its audits and site visits to detect undeclared PEs, issuing significant tax assessments. The SAT's 2025 master plan emphasizes targeting high-risk sectors and operations, using AI and advanced data analytics, and strengthening interinstitutional cooperation. If a Mexican entity performs activities that form part of an integrated business operation, this may indeed constitute a permanent establishment. While no public figure exists on total collections, the SAT reports a sharp increase in revenue from international tax audits and has toughened its stance against aggressive structures that previously went unnoticed. Companies suspecting that they may constitute a permanent establishment should carefully assess their activities by asking themselves, are Mexican operations integrated with a parent company or related parties? Does the documentation clearly justify that local functions are truly auxiliary? Do agents, digital platforms, or algorithms interact directly with Mexican clients? Do employees or contractors spend extended periods in Mexico conducting business on behalf of the foreign enterprise? If the answer to any of these questions is yes, you should evaluate the risk and allocate profits in line with the arm's length principle. At QCG Transfer Pricing, we help multinational groups navigate Mexico's complex international tax environment. Don't take unnecessary risks. If you operate in Mexico and are unsure whether you have a permanent establishment, reach out to us. It's always better to prevent issues than to face an increasingly sophisticated and aggressive SAT. Remember, economic reality is what truly matters.